Welcome, guys, to another episode of the Evolution Podcast. Today, I've got a special guest. We're going to be discussing everything investing in real estate. We're talking about private equity. And honestly, in the recent days, this is probably by far going to be one of the most interesting topics that I've delved into. So, Stephen, if you want to go ahead and introduce yourself.
Hey, pleasure to be here. I appreciate the invitation, and my name is Stephen Pesavento. I'm the host of the Investor Mindset Show. I run Von Finch Capital, and I've been doing real estate for over a decade. Worked in tech, worked in management consulting, kind of worked across different business areas, and so far today we've bought just a tad under $200 million of real estate.
Wow, $200 million worth of real estate. Okay, so now regarding Von Vic Capital, right?
Von Finch Capital.
Finch Capital. Okay, so now how did you get started in that?
Well, when I got started in real estate, I didn't have any experience. I had no connections. I didn't come from family money. But, I had worked in management consulting and then worked in high growth tech. And since I was a little kid, I either wanted to be a chef like Emeril Lagasse or wanted to renovate houses like Bob Vila. And finally, all that HGTV paid off because I decided to push my chips in. And what it really came down to was I made a decision. I decided that this is what I was going to do. And I went through this process that led me to that decision, which I'm happy to talk about. But when I finally made that jump, I immediately went out to go and find somebody else who had already been doing this, who was already successful in real estate, and I could somehow add value to them and in exchange have an opportunity to be able to see and learn and understand what it is that takes creating a great business. And in that first year, I bought over 75 houses in two markets, average purchase price about $250,000. In the following, total of 2.5 years, bought over 200 properties. And after that, we transitioned into buying large commercial apartment buildings and other types of assets similar. So there's been a little bit of a journey along the way of growth here.
Interesting. So the capital per se, is it more of a fund where you're taking in accredited investors, or you open the capital to more non-accredited investors?
At this point of our evolution, we accept almost exclusively capital from accredited investors, and it's really for one reason. And that reason is the SEC has guidelines about what an accredited investor is versus a non-accredited investor. And they create a big incentive for firms to only work with accredited investors.
What's
So
that
sometimes
incentive?
we'll do different deals with people who are part of our very close network who might not be accredited. But for the most part, the reason for that is the sponsor operator takes on a lot more liability. The process is simpler when working with accredited investors. And that's because the SEC has the belief that if somebody's accredited, then they have at least the financial acumen, if not the financial income, to be able to make up if there ever was a loss. Now, fortunately, we've never had a loss to investors in our portfolio. And, in investing, there is always risks, but we've had, a great track record over the last decade.
Interesting. So break it down, if you can, for someone watching this who isn't familiar with what an accredited or non-accredited investor is. So what's that criteria per se to be able to invest?
So this may change in the next few months. We're recording this in March and April, but an accredited investor is somebody who is earning over $200,000 a year if they're single, or over $300,000 a year if they're married, and has done so for the past 2 years and believes they're going to continue doing that. Or they have over $1 million of net worth, excluding their personal home. Either one of those makes you accredited. Now, there's been some discussion about an accredited investor test where non-accredited investors don't meet that qualification, could take some kind of course or get approved to be able to show that they have the knowledge and acumen to select investments, but that's not currently available. And the second reason, it's good for people to understand, regardless of how much money you have, when you're making an investment, you want to make investments that aren't a huge percentage of your total net worth. So the challenge with non-accredited investors is that if you have, say, a $500,000 of net worth and you want to make a $50,000 investment, well, that's 10% of your portfolio. That's a fairly large allocation for somebody making that one single investment. So Despite the challenges, if you're not quite there, the biggest recommendation I have is obviously get your foot in the door, build a relationship with somebody who will allow you to invest in their fund or their syndication if that's what you want to do. Or what I really recommend is focusing on building that income stream so that you can earn more money. Because the biggest thing in investing is you obviously have to have money to make that investment. And so if you can solve your income problem first by focusing on building skills, expertise, knowledge, that leads you to earning more money, then you'll have more of that income to be able to save and then of course invest to start kind of changing your financial future.
Interesting. So now, just this is just more of a personal question per se. So let's say someone is investing 50,000, right, into a capital, right? Some funds require $100,000 minimum investment. It all depends on whichever one you decide to get into. Why would I'm thinking about it from a perspective of why won't someone just go directly and say, I'm gonna put that $50,000 and use that towards a down payment to go ahead and buy the house or buy an apartment? What's the difference between buying it per se versus going to invest that $50,000 into your fund?
Yeah, it's a really good question. So at the core of it, the first thing I'll say is buying a personal home is almost never an investment. A lot of
Why is
people
that?
have been sold their whole life. Buying a home is the American dream, and it's phenomenal. And I think there's great things about it. But usually, when someone's buying a home, they're being a consumer. They're going to spend money on that house to live. They're going to upgrade that house to match the things that they personally want. And oftentimes, those are from decisions that are personal rather than financial. Now, a lot of people have had good exits from their homes, and that's awesome. But in a normal market, it takes about 6 to 7 years to break even on the difference between renting in a market versus owning in a market. And that's because you have your mortgage, you have your maintenance costs. If you happen to have any major systems fail, like a roof or an HVAC, or you have to do some kind of renovation that wasn't expected, those things eat away and obviously cost you money. So buying a personal home, personal decision, absolutely do it. I just don't personally see it as an investment. An investment is something that's going to grow in value consistently over time, and that is going to be paid for by income from some type of stream. So you're paying for that house. Therefore, I don't see it as an investment. We could argue about it. But the second piece of it is if you're going to go buy a single family home or a small apartment building and you put your own money to work, there is an opportunity for you to do that without being an accredited investor. And the advantage of doing that is that you're going to trade both your money and your time and your experience to then go and create a return. So I see buying something yourself and operating it, that's like buying and operating a small business. And so it can be a great way to make money. I personally started by flipping houses and buying rental properties with my money or money that I had borrowed from lenders. But at the core of it, the challenge is unless you really have a good understanding of what you're doing, and you have the right relationships and you do the things that I talked about getting around the right people and learning those skills and knowledge, it can be a very challenging endeavor, not only to find a really great discounted deal, but then to be able to do the operational things necessary to create, a really strong return. So when you do it yourself, you're trading your time as well as your money versus when you invest with an expert, when you invest in an operator or you invest in a fund, you're essentially hiring that person to go out and do all the work. They're bringing their skills, expertise, knowledge, relationships, and their balance sheet that allow them to get deeply discounted deals, be able to create value from day one. And then because of that experience and the scale, they oftentimes can do construction at a much lower cost. They can operate better. So for the average person, I'm all for buying a single family home and turning it into rental and learning the thing more from a learning standpoint so you can really understand and take a risk on something smaller. And it's great if you don't have a lot of money. That's a great way to add your time to the equation to create a return. But at the end of the day, the wealthiest people know that how can I leverage my money without my time to be able to create the biggest return? And that's where the money starts working for you. And so that's why most of the wealthiest people will find other experts that they can leverage, where they're going to get 80% to 90% of the profit off of the deal as the investor, and that operator makes 10, 20% based on the success of the project.
Now, in that situation, you're discussing more of a partnership. But if someone's invested in a fund, you're getting what? How many? What's your percentage that usually you pay out to your investors?
Well, it depends. Every deal or every fund is different depending on the operator that you're talking to. But in the funds and individual investments that we do, investors are typically getting somewhere between 70 and 80+% of the profit off of the deal. So for
And what's the
example,
typical? Yeah, go ahead.
like we had a fund that we just closed, so it's not available for investment, but we do these, quite often. And investors would get 85% of every dollar of profit until we double their money. And after we double their money, they would get 70% of every dollar of profit. So what that does is it creates an incentive where we as the operator are profiting on the back end, 15%, very small amount, but we have an incentive to get into a higher tier so that our goal is to create that higher level of return, because that's how we get paid. And the investor earns that money without having to do any of the day to day.
Okay. So if we're doing 80% of the profit, right? You say a typical profit on a deal will be, what's the after net expenses and everything? What would you say is the average? Are you taking 10, 15% of the total investment is the profit?
Well, two quick things. One, nothing that we're going to talk about today is investment advice. You should talk to a lawyer, CPA, or
Absolutely.
financial person and make your own decision. But the second thing is, when it comes to investment deals in real estate, I'll talk about them from two different perspectives. The first is an income-focused opportunity where the goal of the fund or the investment vehicle is to create a distribution in income. That might come from a promissory note where you're getting a fixed 8 or 10% interest every month, regardless of the success of the project. Or you're in an equity position where you're getting a distribution somewhere in that 6 to 8 to 10% range. On the other side of the equation is a growth-focused investment where you are getting limited distributions, because the focus of the investment is not about those distributions in the short run. But in a 3 to 5 year period, you might be getting a 20 or 30% average annual return. So what's interesting about this is that knowing those two different strategies, you then can look at, well, what am I looking for personally in my portfolio? Am I looking to grow my money, or am I looking to create income that I'm going to live off of or use for some other purpose? And oftentimes it's a hybrid. It's about selecting those different types of deals. So just on that growth example, in a fund that we did, we were projecting a 20 to 30% average annual return. So that would mean that in 5 years, you would double your money at 20%, or in 3 years, you would a little bit less, double your money at 30% average annual return. So the returns that are possible in these funds are much higher than if you were doing something on your own, because of the skills, relationship, expertise, and balance sheet that we're able to do. As a result of our relationships, we can get better debt, cheaper debt terms. We can bring more of it to the table. We can get deals that we're buying at 60 to 70% of the current market value. So we're building equity on day one. And then because we have an in-house construction team through partnership, we are able to get the construction done at a 30% to 50% discount. So all of those things start adding up. And because we make our profit on the back end, we're incentivized to make sure that that project runs well. Otherwise, we would do work for 3 to 5 years on a set of projects without getting paid. And after doing this for a decade, we're not in the business of doing that.
Interesting. Okay. So what would you say is more ideal for out of the growth or the income option? What would you say do you guys see the most for passive investors per se? Someone who's like working a full-time job, making, 250, 300 type range. What is a better suited option per se?
Well, the answer, of course, is it depends, because I think whenever you're putting together your personal investment plan, the first thing you want to do is you want to get clear on what's my objective. What do I want? Why do I want it? If let's say you're 35, you're working a job, you like what you do, you don't have a plan or anticipate leaving that opportunity, and you know that, cool, I'm in a really good spot, I want to grow my money. Then probably 40 to 60% of your portfolio is going to be focused on growth. And the other 20 to 40% is going to be focused on income type investment. So you never want to be only in one type of investment. You want to balance your portfolio, and that balance is going to depend on what your goal is. But another example might be somebody who's in their mid 50s or 60s. They've been making really great money. They want to make a change in their life. Maybe they want to change their career, or they want to, take some time off. And let's say they've built a portfolio, of assets that are worth $3 million. Well, if you take $1.6 million and you deploy that at 8%, you're making about $10,000 a month. So you can then back in, well, how much money do I need to make per month? And what is the right vehicle that I can rely on that money coming in every single month? And so you might then move some of that money around so that you can start having that income and living off of that income from a loan or an equity investment that's going to pay you while you're making that transition, or heck, that's going to pay you forever. If you have, $10 million and you're making 10% a year on it, which some people think is a very high amount, it's very achievable once you understand private investing and public investing and how to take advantage of that. $10 million at 10%, it's $1 million a year.
Yeah, that is a lot. That's $1 million, and it's $1 million. But now how does the taxes work? Because if you have a short-term hold per se, your tax is ordinary income, and then if you're more in a percentage where like a 3 to 5 year deal, for instance, how does the taxes work on that?
Well, the taxes, it's very dependent on your specific situation and the individual investment, but I'll give 3 examples. So example 1 is you loan the money in a promissory note, very similar to a CD or a bond, and you're going to get a fixed rate of return. So you might loan $100,000 and you're going to get an 8% return, and you're going to make, $8,000 a year. And those payments might come every month, or they might come annually. That interest is going to be paid as ordinary income, because that interest is earned, every year on that loan. Now, you might also then put $100,000 into a preferred equity investment that's not debt. And that preferred equity is paid as dividend, which is then paid as capital gains. And you're going to pay a lower percentage on the taxes on that interest. But you also might be able to take advantage of depreciation. So when you buy a real estate property, the government allows you to depreciate over a number of years. And that depreciation it's called a passive loss. It's essentially like a phantom loss. You didn't actually lose any money in the investment, but the government incentivizes you to invest in real estate, so you're able to then reduce the income using that paper loss, and you can reduce your taxes. And then the third would be investing in equity, where you're going to participate in the upside. And again, in an equity position, it's capital gains as long as the property's owned for over 1 year. And those distributions are coming out either monthly, quarterly, or they're coming out at the end of the exit. So there's different strategies for different people depending on what they're looking for. Each of them has their advantage, because when you invest in debt or a promissory note, you are in the most secure position, and you also are going to be paid first before everyone else. And third, you're often going to receive that payment regardless of the success of the project per se. But if you're in an equity position, your distributions are dependent on the income that's actually coming in. And so there is potentially more upside available, but you also have some downside where it's possible that those distributions don't come.
Okay. Interesting. Now, what are the risks associated with this? Because, someone can be, real estate someone might say, hey, it's very volatile. You could, invest your money, and then, 2008 happens again, and bam. So what's the risk if because
Real estate is not volatile. It's actually a misnomer. So real estate is one of the most consistent asset classes out there. And I'm not saying this because I'm in the industry. I'm saying this because that's one of the reasons I'm in the industry. So I do have a small stock public portfolio, but I keep it very small because I actually don't like the volatility of the market. Same with Bitcoin or any of these other things. That volatility goes up every day. And if you're an active investor, sometimes you can make money on that volatility. But for most people, including me, I don't like the feeling of that volatility. Real estate is like a slow moving barge. It takes a long time for prices to change, but the market can change radically when the debt market changes. So as long as you have long-term fixed rate debt, you are buying it right, meaning you're building equity on the purchase, and you have a really strong operator in place, the risk is much lower than investing in a variety of other securities like stocks, like Bitcoin, like investing in a business. And so there's that advantage, but your return profile isn't unlimited, right? Because you can only raise rent so much, and the value of the property is based on the rents and the income. So the biggest risk that I would say in real estate, investing with a fund or a syndication, somebody who's managing that for you, the biggest risk comes down to who you're investing with. So the biggest mistake I see people make is that they hear about the opportunity, they see the opportunity to get involved, to start making some money in real estate, and they're excited and they want to rush in. And so they go and they make an investment, but they don't really gain the skills and knowledge to understand what is a good investment. And they don't take the time to really get to know the operator and the team, to look at their track record, to watch what they're doing, to be able to understand what that investment looks like and what's expected. And they rush in. And so when it comes to private investments, anything that's not in the public market, it's really important to make sure you're selecting the right people to invest in. So what that means is you hear about something on a podcast, you don't just rush in and write a check. What you should do is you should take small steps in that direction. You should have conversations with the team. You should look at the information. You should gain a better understanding about what makes a good investment. At the end of the day, it's not about the property or the project you're investing in. It comes down to who's running it and operating it. Because somebody who has been doing this for a decade is going to have the scars and the experience from other lessons that have been learned along the way that someone who's fairly new at this might not yet have that experience to know how to solve those problems. Or they might have the balance sheet, meaning the money on hand themselves, to be able to back something up if it's needed.
Nice. Okay, I like it. So it's more of basically reputation deal. So because what's funny about this is right before we did the podcast, I spoke to one of it's a fairly well known investment company, and they focus a lot with REITs. And we had we had the discussion, and then they were like, yeah, you should do this, and I think they're a great, phenomenal company. But the same thing you said is, before you invest in a deal or invest with a company, you have to understand that company. You have to understand the market. You have to understand what it is you're doing. So I'm kind of still in the research phase. Now, I have what puzzles me here is, how did you get started, getting into, the capital management deal and, real estate. And also I have a question. This is actually a very interesting question. Do you think we're moving more into a renter's economy as opposed to an owner's economy? So which means more people, renting apartments as opposed to buying homes?
Yeah. So two quick thoughts. One is, I would say investing in operators, it's really important to get to know them and to take it slow. 85% of our investors reinvest, and that takes 3 to 5 years for them to see and make that decision to become a lifetime investor. So it's a very patient game. We're very much in this for the long run, and you want to find people who are. When it comes to a renter's economy versus an owner's economy, there's definitely signs that we're moving towards a renter's economy. And here's a couple reasons why. So in the major markets around the country, it's currently cheaper to rent a home than it is to buy a home. It's about 42% cheaper in Denver to rent than it is to buy. And it goes towards that thing I was mentioning earlier, where there's actually a lot of costs that go into ownership that people don't really recognize. And ownership is more of a forced savings plan. Yes, when you sell your home, you've built up equity, but oftentimes that's because over many years, you've pumped money in, and that's grown at a very small percentage. But the other piece of it is that when you look at, people aren't able to afford to buy homes in some of these markets, and they're making decisions that they might not want to live in a home for 5 to 7 years in order to make sure that it's a break even. So it actually makes more sense. So there's a lot of people who are both savvy. I personally own, like I said, over 180, $200 million of real estate, and I rent. And if I owned the home that I live in, I would pay between 30 and 40% more just for the mortgage, let alone having to fix it up and renovate and deal with issues that come up. So I'm making a personal financial decision not to own. At some point, I will again own a home, but not because it's a good investment. The other piece of it is there's a whole population of people who cannot afford to buy a home. They're not making enough money. They don't have the credit. And so it is pushing towards a renter's economy. And you're seeing that in major markets across the country. So that obviously is a huge advantage if you're an owner, if you're an investor, if you own that real estate that's being leased and rented on, because then you know that there is a long-term trend of people being in a home that is rented, or an apartment that is rented for a much longer period of time.
Okay, so I'm still kind of curious on you familiar with Grant Cardone, right?
Yeah.
Yeah, so I've been to a few of his conferences, and everyone in the in the real estate space always says, rent where you live, rent where you live, rent where you live, right? And it never really, what's the word? It's kind of hard to have that wire in and go, okay, well, I could, if I'm purchasing all this real estate for people to, rent from me, then it only makes sense for me to actually own where I live. But what's your mindset behind not purchasing your home?
Well, I think let's just understand where that belief comes from. So beliefs come from either our past experiences or other people passing along that belief to us. So after World War II, all of the soldiers came back. The economy was in a very tough position. We essentially were spending all of our money on weapons and war, and the government knew that they needed to focus on growing the economy. And what's one of the best ways to grow the economy? It's with leverage, it's with debt. And so the bankers, essentially put together the mortgage association, and they said, hey, well, right now we lend a lot of money on businesses, but businesses are inherently risky because not all businesses work out. We can't really track exactly where the money goes. What's a much more secure type of loan to make? And that would be real estate, because one, we know this is a hard asset. We can take it back. We can then turn it around and do it again. And so there became this big push on the American dream of owning a home. And don't get me wrong, there's a ton of benefits of owning a home. But at the end of the day, from a financial standpoint, for the first 5 years of your loan, you're paying majority of it is interest, like a significant majority. The first year is like 80 or 90%, and it goes down just a little bit each year. So a 5% rate mortgage, your first 5 years is probably right around the 8 to 9% range, depending on the fees and other things. So that's part of the equation. So just like so many other things, we were marketed to really effectively. That marketing set in, it became a societal trend, and we started going down that direction. It's also the same reason that most of the money that is invested in the country is invested in the public markets. But the reason that is true is because the public markets and all of the financial institutions have been marketing to people for generations in order to make sure that money stays within that system. So every financial advisor has an incentive because they're paid based on how much money is in the market. And all those institutions are paid based on how much money is in the market and based on how many trades are happening in that market. And so they don't get paid doing private investments. Your financial advisor won't make money when you come and invest into my fund. So there's an incentive for them, one, to not really know that much about it, but two, to keep that money in that system. So that's where it comes from. And like I said, there's nothing wrong with buying a home. I think there's a bunch of advantages on a personal standpoint that you can have. But financially, you're better off getting that money working for you in some other format that you can then take and then put towards something that you really want off of the income that's coming off of those investments.
Okay, I love it. I love it. I love it. Okay, so you had mentioned a little bit earlier when we mentioned volatility, right? And you had mentioned running a business is very volatile, and I can attest to that. Running a business is because in a business scale, a lot of people come to me and go, "Hey, I wanna start a business. I want to do this," and I say, have you looked at historically what the profit margins have been in your industry that you're getting into, right? And a lot of people don't. They don't look at it. So a friend of mine was like, "Yeah, I'm gonna go into trucking." And I had a guest on who used to have a trucking company, and the profit margins on a trucking business is 4%. And I said, because he was marketed to, and he said, yeah, you can make 5,000 a week. And I said, okay, 5,000 a week. How much do you think you're paying on gas? That's roughly about 1,500 to 2 grand. How much are you paying on insurance? So in a way, you're actually losing money running a business. So would you give I mean, obviously nothing here is given as financial advice per se, but would you say someone who's looking in the position of starting a business, would you say it's a better deal to actually invest that money in a fund per se, as opposed to going, out in the wild and saying, "Hey, I'm going to go start a business"?
I wouldn't. I wouldn't. I'd recommend against what, my own personal interest, which is obviously raise as much capital and create as big of returns for my investors as possible and build a long relationship. Obviously, that's all in my favor. What I would say is that if you're really good at running a business and you understand how to run a business, and running a business is not running a job. Most people who are entrepreneurs, they are consultants or they are buying a truck and driving it. That is a job. You're self-employed. But running a business where you can get leverage by having individual people who are doing most of the day-to-day activities of that business, and then you as an owner are able to collect distributions. Most businesses fail because it's challenging, but for those people who are good at running businesses, you're going to get the biggest ROI off of your time plus your capital to run that business. Now, that's the question that it comes down to, though, is what's the outcome that you're after? Are you excited to run the business? Are you excited to get in there and hustle and grind and grow a business, or buy a business and then grow a business and hire the right people? Or are you at a position where you have a skill set and you're really good at doing it, and you want to take the money off of what you're earning and invest it so that that nest egg can grow, so it can compound and double and triple and quadruple over time, that you can then pull income off of in the future? I would recommend that if you want to run a business and nobody can convince you not to go and do a business, then you should do a business. But if you can be convinced by somebody else not to do it, and you are easily dissuaded away from it, then you probably shouldn't go run a business. And instead, you should find a career that you love and find an entrepreneur or find a business that you can go and work for and tie yourself to the success of that business. And then again, take the income off of that, save 25, 30% of what you make, invest a portion of that into things that are going to grow over time. I would say it's not an either or. Even if you're running a business and you're making $1 million or $10 million a year, you're going to have a new problem. And that problem is what to do with the money. Because once you have money, you realize that you actually need to get it out there working for you, because with inflation, that money is losing value, every single year. And you want to then you step into a new role and responsibility, which is, how do I grow the money? How do I protect the money? And how do I create income off of the money? Because then that money becomes an asset of itself, where it in itself starts to create income just like your business does. And you can have multiple of those different streams coming in.
I love it. I love it. I mean, the way someone explained to me about people who wanted to start a business, he asked the question. He goes, "Your business, are you starting a business because you think it'd be fun, cool, or do you think your business needs to exist? Right? Is this
Mhm.
something in which you think it should exist?" And I think there's just a hype for entrepreneurship, it's sexy to say I'm an entrepreneur. Like, yeah, what do? I'm an entrepreneur. But it's so funny. It's like you go on Instagram, everybody's an entrepreneur now, right? But the real
Mhm.
entrepreneurs aren't really out there post on Instagram spending, 100, hours a week, scrolling and swiping. They're actually out there like in the trenches. So let's
I,
obviously
one thing I'll say on that, I think entrepreneurship has become a sexy thing, but what I hope that people will take away once they jump into it is that entrepreneurship is about being tough and resilient and being able to get kicked in the face over and over again and getting back up and asking for more and taking the beating. But when you're taking the beating, you're taking the lessons in. So, and a good entrepreneur is not afraid of failure. They want to fail in small ways so that they can learn and then grow those failures into bigger failures so they can learn, so that more importantly, they can then do the right things and not have those kind of failures, not have those types of challenges. But using Instagram or social media or podcasts or any of these things could be a great way to be able to connect with people and build relationships, one person to many different people, in order to share a message of something that you think can be of value. But there's a lot of fake people out there. There's a lot of people who are just posting crap online, telling you about how you can make money off of them. What I'll tell you right now is I run a private equity firm. Our job is to make money for our investors, and we don't make money unless they make money. So whether anyone listening wants to be a partner of ours, it's a long process of getting to know the company and us bringing through a process, see if you're a good fit. But there's a lot of people who are trying to sell you a product that you hope you're going to make money off of. And those are some of the biggest things to stay away from.
I love it. I love it. Now, regarding what's the minimum investment for people who want to work with you?
It ranges. It's anywhere between 50 and 100,000. We have some investments that require 250 to $1 million. So it depends on the specific opportunity that we have. But if somebody is interested in getting involved and starting down that due diligence process, you can go to vonfinch.com/invest. You can start finding out a lot more about us, and you can set up a call with a member of our investment team to dive into your personal situation and get your head wrapped around, and we'll decide if it's a good fit for us. And if you decide it's a good fit for you, then, we can proceed.
Now, as far as liquidity, how liquid is it? If someone invests 50 grand, because most funds have a 5-year hold, a 3-year hold. What's the minimum?
It really ranges. Every investment is unique. We have investments that are a 1-year hold. We have investments that are a 3-year hold. We have investments that are 5, 7, and 10-year holds. So it'll depend on your personal situation and what the actual opportunity is that we have available. But they range, and it's good to be able to bring a blend of those different things into your portfolio depending on what your goals are.
Hmm, interesting. Okay. And you say distributions are made quarterly, or is it more of how does that? I think we
Every
spoke a little.
investment is different. Some
eh,
investments do monthly distributions, some do quarterly, some don't do any distributions until the very end of the project, which could be 3 to 5 years, despite creating cash flow and creating income at the project level. We may not distribute that cash because we can compound it and create a higher rate of return. So there's a variety of different options, and people just need to go to vonfinch.com, set up a call, and then they can figure out what's currently available when it comes to the specific opportunities.
Interest. So how did you learn? Because obviously you control more than $200 million in real estate, which is no small feat. So how did you first off, how did you manage the capital to be able to purchase? You said 75 homes in the beginning before you met your mentor. How were you able to manage that?
Well, at the end of the day, I think if you want to go out and do something, what I did was I decided that I wanted to make this move. I went all in. I spent thousands of hours, no joke, listening to podcasts, reading books, talking with mentors, building relationships, and then, of course, finally building a network of other people who are already doing what I wanted to do. And I found ways to get in rooms, both ones that were free for me to get into and ones that I paid a lot of money, to get surrounded by other people who were thinking on another level so that I could change the way that I thought and also build the skills. But then finally I went and I took action. I started at a place where I could wrap my head around and believe that it was possible. And I started building that business. And so for me, it all started with that decision. And people can make that same decision regardless of what it is. It could be a decision to become a professional investor, to start learning the skills and strategies to be able to invest well into these private investment opportunities and to be able to take control of their financial future. And so all of those things are possible once you get yourself in a place where you're clear that I'm decided, I'm going to do this, I'm going to learn. Everything's not going to go well at first, or it's not all going to be easy. And even if it is, there is going to be challenges along the way. With that in mind, that'll allow you to then keep moving forward in the direction that you actually want to arrive to.
Interesting. Okay. So you mentioned listening to the podcast, right? And I know you have a podcast of your invested mindset. So, and you've had the podcast, you've been a host since 2016, right? Now, if you want to talk a little bit more about like what can the listeners get, if they come listen to the podcast, well, what's that value at?
The Investor Mindset Show is all about teaching you how to think like an investor, thinking like an investor in your business, in your life, and in your investment portfolio. And so when you think like an investor, you're thinking from a different perspective than most people. You're looking at your job as, how can I add as much value as I possibly can to the company's bottom line and to the company's valuation? And how can I come in and participate in that value through stock or profit sharing plans? When you're a business owner, you're thinking not about how much money I'm going to come in off that business. You're thinking, how do I increase the value of that business? And then, of course, when it comes to an investing portfolio, it's pretty straightforward. But what we talk about how do you think like an investor, and what are those different skills and strategies to build up so you can have the knowledge, skills, and expertise to have the confidence to do it. And so it's a really powerful tool. I love doing it, been doing it for many years. We've had millions of downloads and had some incredible people like Chris Voss and Mark Manson and a variety of other notable guests. And it's just a lot of fun.
No, that's a big fan of Chris Voss. No, that's good. So as we wrap up here, so where can people find you?
Yeah, the best place to follow me is at Steven.Pesavento on Twitter and Instagram. That's where I'm most active. I'm on all the platforms from LinkedIn to anything you can imagine. And then the Investor Mindset Podcast is the name of the show. And you can find out more about that at investormindset.com.
Okay, perfect. All right, guys. So the links are going to be in the description. Definitely go show Steven some love. And also definitely if you guys want to learn more about investing, which honestly, I'm taking on more of the mindset of an investor. I gotta listen to the podcast more a little bit, get more of that mindset. So, we're going to be shifting more into that investing concept because I just adopted one rule, never lose money. So even if your money might be tied in for a little bit, as long as you get the money back, as opposed to taking unnecessary risk. But then again, guys, if you're on YouTube, please go ahead and sub to the channel. And if you're watching on Spotify, go ahead and give us a good review. I think you give reviews on Spotify, and also go ahead and follow the podcast. Thanks again, Steven. It was great having you on. And everyone, thanks again for everyone joining on right now. You guys have a good one. Bye-bye.